Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is June 29th, 2023, and today the video is about GDP signals more rate hikes needed. We're going to start with looking at this lovely little bounce today we have in the market. You can see higher highs and higher lows in the continuation, but we're really consolidating and have been for the last 2 weeks on the SPY. The question is, what are we seeing from the Fed? What are we hearing from the Federal Reserve, the European Central Bank, and the Bank of England? And what are we seeing in growth versus interest rates? GDP, or final GDP, was released today. And if I jump over to the Forex Factory for the calendar, you can see if we look at final GDP came in at 2%. The Federal Reserve's goal or target is between 2 and 3% GDP. They would like to see obviously higher, but 2 to 3% is kind of this benchmark. But additionally, they were raising rates to crush demand, to stop demand and get inflation in check. They raised rates, then they paused rates. Final GDP says that the pause was too early. Final GDP says that we're still growing, in fact, growing at a faster pace than what was predicted. We were predicting a 1.4% rate. We came in at 2%, and we're still seeing a very resilient economy that doesn't care that we raise rates into the fives and that we can continue to handle more rate hikes before we see true destruction of demand. Even if we just look at the last week, you can see core durable goods, Richmond's manufacturing index, consumer confidence, new home sales, and even weekly unemployment claims all in green, beating expectations, showing that the employment situation is good. Confidence from the consumer is good. Home sales, as far as new home sales, are increasing, so we're continuing to add supply to that market. And durable goods orders, which are usually the bigger ticket items, we are showing that we are still spending, we are still growing. Now again, that's a good thing for a normal growth economy, but it's a justification, or maybe not even a justification, but a requirement now that the Fed, to get this inflation under control, has to continue to raise rates. If we look at the rate decisions in the past, in the pause, we've talked about this before. The European Central Bank raised rates. Bank of England raised rates and added an extra quarter point surprise. Reserve Bank of Australia raised rates and added an extra quarter points of surprise. The New Zealand Reserve National Bank of New Zealand raised rates. Bank of Canada raised rates. Everybody raised rates except for the US dollar, and the US dollar didn't raise rates, and we still see that this is not the time to do it. We are going to be falling short of getting inflation under control. And that's what we've heard all week this week. So as we're watching this, let's go take a look at the ZQ. Now this doesn't look like much because this is the June's contract. You can see it's June's contract, and we had to unwind it. Our current rate is between 5 and 5.25%. To see what the rates are pricing in and how the market responded to GDP and some of the other things that are going on, we need to push this forward into the next month. And so we're going to go to N23. ZQ N23 is looking at July and saying, hey, what do you expect to happen in July? July is pricing it in 94.895. What we can do is we can take 100 and subtract off 94.895, and that would give us about a 5.25%, 5.25%, which is fine. We're not really seeing it priced in here. But if we look out into the future months, let me show you in the comparison as far as price action. From the trade tab, you can actually see all these. I just want to see the numbers. As you can see, as these numbers get smaller and smaller and smaller, all of those are indications of rate hikes. It's not until it starts to go back up out in December of this year that that's the first sign that we don't think we're going to continue to raise rates. So what we're pricing in currently is more rate hikes until December, and though November and December are roughly the same number, but December is showing that we are looking at about a 5.4, 5.5% rate. So keep that number in mind. If we go look at the CME Fed Watch tool, and we look out to the changes that we've seen here, what we're seeing for July is we're now 86% probability of a rate hike. We're currently at 5%. Let me scroll this down. We're currently at 5% to 5.25%. Like I said, we'll call it 5 1/8. And we're looking to raise it 1/4 basis point, or 1/4 point, 25 basis points to 86.8% probability of that being the case. So July is already pricing in one rate hike. As we look out to September, the next meeting, And the Fed chair, Jerome Powell, said that we could see back-to-back consecutive rate hikes. The current is there again. We're now showing that the rate hike is only 66% here, but that's not really what that's telling us. We're pricing in one rate hike with an 80-some% probability odds for July, and then we're pricing in a second rate hike at about 24%. So the probability of cutting again by September is less than 10%, and we're pricing in a higher likelihood of a second rate hike by September. So a lock for July and about a 60% chance of leaving it alone in September and a 24% chance of raising it for September. If we go out to November, watch what happens as we start to see this shift. Now, current rate hike, we're a little bit higher probability that we'll have that second rate hike by November, and even a little tiny probability of a third rate hike by November. Now remember what we saw the rates for December. If we look out to December now, according to the CME Fed Watch tool, now we start pricing it back to 8% that we're going to be cutting. Remember, current expectations, current rate is 8.4%. One rate hike, two rate hikes we were pricing in the before, we're not seeing any more being there. We're actually starting to reduce the third rate hike. We're reducing a little bit the second rate hike and putting back some probabilities back to a rate cut. What I see here is if we do raise it to 2 points or two hikes in September or November, that we're now pricing in about 50-50 odds that we'll be cutting it back to 5.25 to 5.5% by December. So we are starting to see that skew push back down to the downside again by the end of the year. But that's still pricing in two rate hikes. One of the other things we want to look at as an indication of consumer spending and confidence is prices of homes, new home construction. Prices went up 0.7%, not a big deal, but we saw a major bump in new home sales going from 677 to 763. Major increase in total number of new home sales, new home construction. But pending home sales dropped 2.7%. That means the existing homes that are under contract that haven't closed is falling. If you look at the previous months and the forward projections, you can see April and May also slipped. So we're seeing less homes under contract at these higher interest rates. We're seeing the interest rates move higher as we are pricing in the Fed's rate hike. We're seeing bond prices sell off, and the ZN and the 10-year Treasury bonds prices fall and yields go up today on this expectation. Additionally, it's good to note, we've talked a little bit about this in the past, we have seen all this really positive news that says consumers are confident, we are going to continue spending, we are resilient, we're going to grow, don't worry, everything's fine. And yet we keep adjusting the data down afterward. We keep revising in the forward months, we keep revising the previous reports lower. You can see here on even on new home sales, which was stellar, every single month except for one this year has been revised lower. 610 to 602, there's 8,000 less, 5,000 more, 17,000 less, 10,000 less, and 9,000 less. So we have tens of thousands of less home sales than what was originally reported, is what this is telling us. So the data and the news that we're getting from new home sales is not nearly as positive as was initially thought. Pending home sales are slipping and have slipped multiple months. As the Fed raises rates again, remember this data, the positive news that we're seeing here, is propping the market up, but it's artificial. It's not really there. We're not seeing that growth and that expansion that we've seen. And if we keep revising these lower, then we can assume that these numbers that we're posting up initially are just speculation on where we think we could be. And reality is we are not seeing that growth. We're not seeing the expansion. That would also play into GDP. If GDP is showing 2%, 2.5%, 3%, as we've seen in these previous months, 7% as we saw a couple of years ago, final GDP, if these numbers are feeding into that, that would be one thing. But reality is these numbers are much more stellar, much more positive than reality, and GDP was better than previously thought and not revised lower. And this is kind of the final determination. This is setting us up for the data that we're seeing in the revisions to see GDP roll down. But if GDP is at this level, then the Fed is justified, set up, and following that idea that we should continue to see future rate hikes. And unless you think that I'm putting too much value in this final GDP, I want you to see how the bond traders reacted today. Bond traders broke out of a consolidation that they've been in for over a month. We've had all sorts of data. We've had preliminary GDP. We've had CPI. We've had PPI. We've had every major announcement, including employment and growth and GDP and PCE, all the major announcements, and the price just consolidated. Today on final GDP, we broke down. This breakout from a price pattern perspective, just from this time frame, would put us back down to these lows back in March. The coordinated value in that would be that the 10-year Treasury should be reaching back up to the March highs, which would push us back to about 4.1% for 4.01%. We'll just call it 4%. That is an increase from our current price, or even from just yesterday, of a quarter point or 25 basis points. That puts borrowing costs, home mortgages, commercial lending, all at 6-month highs and approaching decade highs. So if we see the prices move back in here, if this is the first breakout and we see it continue to this level at 4%, and possibly, look at this from a price pattern perspective, today is the breakout. If we measure it from here to here, the base of the consolidation, and call that the breakout, we're looking at a full target of 4.475. We'll call it 4.5%. A 4.5% yield in the 10-year Treasury should see about a 6.5 to 7% mortgage rate. That'll be the highest the mortgage rates have been for a paper in a very, very long time. In fact, we can go back and see that that will take us well past the 3-year, past the 10-year, all the way back to levels not seen since the previous real estate crisis. So this GDP number, as simple as it is, as basic as it is the final GDP, and that usually doesn't have a reactive move initially, it is the final determination, the final information, and justifies, if not requires, the Fed to respond to continue to fight growth and inflation. And this GDP number is signaling more rate hikes are needed and more rate hikes are ahead. If we can sustain it at these levels, then we can certainly sustain it at 4.5. If we can sustain it at 4.5, we may even see it go all up to 5.1 and reach the highest levels going back to the 2000s, even to the 90s. And if we go all the way back to that level, the cost to borrow will be so high that we will see destruction of demand, and we will see GDP slip, and we'll finally see consumer confidence slip, and potentially the economic slowdown that is necessary to get inflation under control. One of my favorite indicators from a global scale as well as just in the US for growth is copper. Copper prices have rolled over, given us a warning already that we created an equal high. We've already sold off and we're seeing this bearish move. GDP that is saying that we already seen growth. If we're going to continue to raise rates in the US, as we have done in every other country other than the US and Japan, we'll continue to see higher cost and a further squeeze of manufacturing and growth. Copper prices have already started heading back down. We're going from $4 possibly down to $1.60, which is a 10% correction. If we break through these lows, this price pattern, giving us from 4 to 360, would duplicate and bring us down to 320, which would bring us down to annual lows on copper. That would be the lowest demand, the lowest growth in copper prices for the entire year. But it's, again, not just this 1 year. You can see that that 320 price is the lowest price that we would have going all the way back to 2020. That's a significant correction, a significant fall. So we are setting up for this perfect storm of falling demand, while we're seeing GDP saying that we are growing, while we're raising rates to stop the inflation and stop the growth, and we're already seeing it play out in copper being an early mover, bond prices breaking out to the downside, which means yields are breaking out to the upside. We're set up from a price pattern perspective and a fundamental perspective to see a significant squeeze in lending. And if we can't lend, or if we're squeezing on lending, then we'll have less borrowing, less expansion, less growth, less demand, less manufacturing, less employment. And we finally reached that point. Today could be, at least based off the charting, could be the day that we finally saw the breakout in bond prices, in copper, and possibly the top in U.S. equities. We'll see how it goes. And as we watch for these yields, we want to watch those yields both in the short term, the 30-day Fed Fund futures, as well as the 10-year and 30-year. We want to see that inversion, that inverted yield curve, correct and get back to a normalized yield curve. Which brings me to the final point. The Treasury yield curve, looking at short-term versus long-term, has become one of the steepest levels it's been in 40-plus years. We've also been in this inverted yield curve for one of the longest time periods. Historically speaking, within 6 months to 18 months, we go into recession. We are already at about 9 months of time since that inversion happened. And as you can see, this is the current month. If we look down here and look at the 2-month, 3-month, 4-month, those are all rising. From that 4-month, we start to drop. So we see higher payments for longer maturities, but then we start to drop and we go from 4-month at 5.5 to 5.4, 5.3, 4, down, 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 to the lowest point, then the 10-year at 3.71. We see those drop and drop and drop. The difference between the 2-year and the 10-year, which we will love to compare, is 4.7 to 3.7. We're talking about a full percentage point difference. The percentage point difference says that we are being compensated more, 25% more roughly, 20% more, for a 2-year than we are a 10-year Treasury yield. There's no incentive to invest in the long term. That 3.7% versus a 4.7% has remained inverted all month. And we've seen those inversions carry down all the way through. This 1% difference is the steepest it's been, or near the steepest it's been, for 40-plus years. And we've remained in this inversion for a very long time. Until this starts to correct, we will be still threatened by a long-term or significant economic pullback, if not recession. So those are the things to watch. We will look at this again next week. Have a great week, everybody.